Three, two, one. On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and we have breaking news. The Federal Reserve has just cut interest rates for the first time this year, cutting its benchmark rate by 25 basis points or 1/4 of 1%. With me to break it all down is Jose Torres. He is the senior economist at IBKR. Jose, Wall Street traders were expecting the 25 basis point cut. But what were you expecting and why?
I was expecting a 25 basis point cut as well. The committee is still worried about inflation and the potential that tariffs could drive price pressures north in the future, although they really haven't in a meaningful way yet. I think what surprised me the most, so you just had one dissenter, which was Stephen Myron, who came through from the White House. He's filling that governor role in the short run. Big surprise though, Todd, for me was the two more rate cuts in the dot plot for year end. So that was a big surprise. That has Wall Street pretty enthusiastic right now. Look at the Russell 2000 up 2.2%, the Dow up a full percent. Tech is nearing its flat line. It was down earlier due to international concerns, and the S&P 500 also close to making a new high here at 66.24. So investors are very excited that they're going to get probably two more rate cuts by year end, according to the dot plot.
Two more rate cuts with two more meetings left. But I want to talk to you a little bit about that because the next meeting isn't for 6 weeks. Do you think the Fed is taking on too much risk by not cutting enough?
I think so. I definitely think so. I thought that they should have been cutting a long time ago, preferably in the summer. Especially when we saw that the tariffs were just an average rate of 15% roughly, a lot lower than what we feared back in April when President Trump came out with the big board and the numbers next to each country, and those numbers, a lot of them were in the high 30s, were in the 40s, it was frightening. So with a tariff rate of just 15%, only really focused on core goods, which only comprises 20% of inflation, it's not really enough to move the needle and drive inflation much higher. But what's been actually supporting price pressures, which is not actually a terrible thing? It's been services. Last few reports, we're seeing services driving price pressures higher. Do airfares increase sharply during an economic slowdown? No, they increase when you have an acceleration. Do hotel fares increase when you have a slowing economy? No, you have an acceleration. And that acceleration theme is present in the dot plot because the committee did increase its projections of economic growth going forward.
So you're suggesting that the economy is thriving, according to that last statement. So if that's the case, then why cut it all?
Well, the economy overall is doing great. Risk assets are doing terrific. Safe haven assets are performing robustly as well. But Todd, there are some pockets of the economy that aren't doing well, namely real estate sector. You saw today, new residential construction report from the Census Bureau, Todd. Building permits, 63-month low, the lowest since the depths of the pandemic. Housing starts, same thing. So real estate desperately needs monetary policy accommodation. Manufacturing, doing great from an investment onshoring perspective, Todd, but not doing well from an employment or from an ordering perspective. Another area needs rate cuts. Finally, small businesses. And this is why, folks, we're seeing the Russell 2000 up north of 2% today and looking to break all-time highs. Desperately in need of rate cuts, very sensitive to monetary policy. So while the overall picture, in short, in one sentence, overall picture great, certain pockets need those rate cuts, and the rally has been concentrated in AI. We want a broader rally. We want more participants because over time, history suggests that that's more sustainable and it's better for long-term prospects.
Right. And the Russell is rising. Historically speaking, small caps have performed well during easing periods by the Fed. But let's talk about the markets a little bit here because you did bring it up. The markets are rallying on this news. And you had the feeling that Wall Street was really anticipating today. But now we got what we wanted, 25 basis points. Now what? Do you see the rally continuing on through the end of the year into 2026? I mean, there's got to be some type of other catalyst out there to actually really have any purpose for any type of a continuation of the bull market.
We just have such a supportive backdrop right now when you consider the political environment, very pro-growth, very pro-business, the milder regulations. I don't think that's been priced in. The S&P is up only, I mean, not only, but it's up 12% year to date. But the milder regulations, that gives it more space to go a lot further. Now the rate cuts also a lot further. Big, beautiful bill, lighter taxes, subdued energy costs, all that in combination, really point to corporate earnings growth re-accelerating here in the back half of the year and into 2026.
Okay, so let's turn back to the Fed here. We know what the dot plot says. Two more cuts. There's only two meetings left this year. What do you think? Are we going to still see 25 basis points for the next two meetings?
I think so. Because all of a sudden, if you get down to, a 3.6 on Fed funds, that's a long way of progress lower than where you were, before this meeting up at the upper end of 450. So getting into the mid threes is a lot of progress already. I don't think we want to see a 50 basis point cut at this juncture. We could have gotten it today and that would have been all right, but we don't want to see 50 at this juncture because that is going to raise slowdown angst. And, it's unless you have a material weakening in the labor market, a 50 is probably not justified.
So I want to turn your attention to tariffs then. So right now, the U.S. is receiving somewhat 400 billion so far in tariff revenue. I would imagine the number is going to increase quite a bit in Q4. With that, do you see that being any type of a drag? Because some economists have come on our shows on BTT. They're calling for a four handle on the inflation rate year over year by early next year. Will that really throw a wrench into the whole calculus here as far as what the Fed's going to do?
No, I'm going to point to what I said earlier about tariffs being a limited impact and core goods not being enough of a share of CPI to move the needle up to 4% year over year. In fact, the tariff revenues have really helped bring down the long end of the curve, helping mortgage rates come down. Look at the 10-year. The 10-year just broke 4% to the downside. The tariff revenues are actually, for a long time, Todd, we have not had good news on the fiscal front in this country. It's been deficits, it's been debt, it's been unsustainable. Those have been the themes. But now you have these big tariffs that are actually bringing in heavy revenues to the Treasury and lowering term premiums or the concern that investors have over the fiscal situation here. And, I think it's great news. It's weird because, as economists, in academia, we're taught a lot about how free trade is the holy grail and how that's the only thing we should be considering overall. But the thing is, Todd, unfortunately, when we become free traders all the way, a lot of other countries start to take advantage of us. So I think at this juncture, the tariffs are a good policy. It hasn't been a level playing field for the U.S. So I think it's a good policy, and it's a great development that those revenues. Hopefully, we get $1 trillion a year.
Okay. Well, we are leading everyone up with this segment up to the 2:30 presser with Jerome Powell. So I have you for a few more minutes here, and I know you're going to have to listen to that press conference. But let's talk about real quick the labor picture right now. We have seen softness. The BLS revisions came out, actually averaged 75,000 less jobs over the past rolling 12-month period. Do you think the Fed took any of that into consideration with their decision today?
I think they did, especially with the dot plot, refraining from cutting 50 today, but adding another 50 in the next few months. One thing I think they learned from last year, markets just turned red, by the way. The S&P is now down a lot.
Because traders are watching this show.
Yeah. One unique thing that happened last year, Todd, is that once the Fed started easing, same month, September, they did a 50 last year. Which, by the way, a 50 last year with employment growth averaging in the last 3 months before that meeting, averaging around 80,000, and now employment growth around 30,000, I think a 50 was justified at this meeting just because of that, because the hiring rate right now in a 3 month moving average is roughly a third of what it was last year when they cut 50. So I thought a 50 was justified. But hiring is going to reaccelerate here because, like I said earlier, those struggling sectors, once you get a rate cut, two rate cuts, three rate cuts, now they want to start expanding. Now they're less hesitant on the hiring front. So I think that roster additions are going to start to pick up. We saw it last year when the Fed cut by 50, hiring began to explode. We started having reports up north of 200,000. So, I don't think because of immigration restrictiveness, the numbers are not going to be up in the 200,000 range, but we can definitely get back up to 120, 130, 140, which are great numbers considering, the growing economy.
My personal opinion was that I figured the Fed had to cut 50 basis points today. You have two PCE data points coming out until the next meeting, another labor report the first Friday in October. So there's a lot to digest, but there's a lot that can go wrong. Going 50 basis points seems to protect the Fed. Right now, they seem a bit vulnerable at only 25, and that's probably where markets are actually saying, hold on now, I don't think they did enough. It's great we're going to look into the future, but it's a whole 6 weeks till we actually meet again. But let's talk about that real quick. You have Jerome Powell. He has 6 months left on the job. And it would be irresponsible of him, obviously, to go in there with this laissez attitude. But I want to ask you, do you think that he's more focused on the Fed and its succession plan at this point, and maybe not focused because his legacy is so important to him? What do you think in his thoughts? I mean, in this press conference that's coming up in a few minutes, are you anticipating any surprises? Because he only has a few more left to do.
One thing I think that if president, one thing that I think Chair Powell is constantly focused on is the perception that he's giving the president what he wants. And unfortunately, I think when the president pushes too hard on the Fed kind of goes the other way to sort of preserve its independence. A shocker that Bowman and Waller, after dissenting in July, they didn't dissent now. I thought that was a big development there. To the previous question as to why you wanted 50 basis points, a point that we didn't add is that June got revised into job losses. It was the first time we actually lost jobs in a month since the pandemic year of 2020. So I think Chair Powell, I think he's just gonna, go out there, poker face, and talk about, the Fed and its dual mandate, not really succumb too much to political pressure, and try to maintain the stance of the institution.
Okay, that makes a lot of sense then. Well, Jose, I think we covered everything on this. I know we got to get together again. We got to start thinking about the Fed presser that's coming up in a few minutes. Everybody's going to be watching and listening to what Chairman Powell has to say, especially as it does lead in to those following two meetings and potential more rate cuts. But I want to thank you for joining me today on the Money Path, and I can't wait to have you back on again.
Awesome, Todd. Thanks so much for having me, and thanks, ladies and gentlemen, for tuning in.
Absolutely. So coming up at 4 o'clock today live, Miss Schneider is going to be joining on a one-on-one interview with Jeffrey Hirsch. He's the editor. He is the editor-in-chief of the Stock Traders Almanac. The two of them are going to be on WealthWise. You don't want to miss it because they're going to break down all the market action during this post-Fed decision moment. So you definitely want to see it. So on behalf of Jose Torres, I am Todd Schoenberger. Thank you once again for joining us on this special report of the Money Path. We'll catch you next time. Take care. Okay, we are out. Hold on.